What do you think? I mean, we had Fed, we had GDP, we had jobless claims, tons of earnings, great tech stocks, semiconductors. What really we even had economic news this morning. What grabbed your attention most, and what do you think was a market-moving event?
Well, let's do the good, the bad, and the ugly, right? So the FANG stocks yesterday just ripped the cover off the ball. How can you not like Apple's 4-for-1 split? Little concern that, you look at the FANG stocks, they make up about 17% of the Dow. We've got an over concentration there, but hey, look, there are parts of the economy, there are places to invest that are going to be impervious for the pandemic. We can't say this enough. COVID's not going to stop 5G. When Apple launches that 5G camera, I'm going to get in line and get one, right? Like millions of other people. So there's some good things. Okay, the bad. Well, obviously, if you watch the Fed meeting and Mr. Powell's presser, you got a real sense that the Fed's really concerned. They've extended their emergency crisis era programs all the way to the end of December. I think they're hunkering down for the long term. We talked about this before. We all geared up for this crisis as if it was going to be a 15-week event. Well, it's going to be more like 15 months, and we need to begin adjusting our expectations. Okay, what was the downright ugly? The GDP report. 33% decline on a seasonal annual adjusted rate, 9% if you prefer, if you're a trader. There's no way to put lipstick on that pig, right? It's the worst single decline in U.S. economic history. What you really saw was a collapse in demand for services. We're a service-based economy. That does imply there's going to be some permanent damage there. Although we've talked about this again before, I've been saying for a long time, 1 out of every 4 of those job losses are likely to be permanent. And I think I might end up being a little bit optimistic on that. So we've got a lot of work to do. We're not going to be out of this anytime soon. And let's just be honest here. V is not for the shape of recovery. V is for vaccine. No vaccine, no recovery, full stop.
Right. I see what you're saying, and then we'll have a victory. That's also a V. If that is the case, I'm actually seeing that New York City schools will reopen if the positive corona cases test rate is below 3%. So they are trying hard to get things reopened, and they're putting some parameters for that. As we move forward, how are you feeling? You recapped the week beautifully. GDP was terrible. Maybe it'll be revised better or worse. It almost doesn't matter in some cases. I mean, if it goes to 34 or 31, I mean,
what does it matter?
Neither here nor there. It goes down as the worst quarter ever, right? So what about the forward-looking numbers? What do you see for our nation, our people? You see these great companies with some great numbers. Tell me your outlook, Joe.
Okay, so one of the first things we did when the pandemic hit was we threw out a lot of our traditional macro data. We started to look at different micro data, and what we can paint is a picture that the exhaustion of the first round of pent-up demand was released. May 1st, it exhausted itself late June. Since then, the economy's moved sideways to down, especially around U.S. consumption. So we're not going to see a 20% rebound in the second half of the year or the third quarter of the year. Right now, what you're looking at is the 10 to 12% variety in the third quarter of the year, and probably closer to 6 to 8 in the second quarter of the year. And that's contingent that the current intensification of the pandemic eases. And I can't emphasize this enough. Our recovery is going to be predicated on the development of a therapeutic, the vaccine, then the production and distribution of it, not just in the United States, but on a global basis. Until we solve this riddle, we don't get to go back to January 2020. So for this year, we're going to have an impaired economy. We're going to have to make policy. We're all going to have to manage our way through that and make investments around that. It's just the honest to goodness truth. And I don't feel comfortable giving it a sunny upside just because we're all about to go on holiday break, of course, quarantine in our apartments.
Right. Maybe you're recommending people save some money. I don't know. Are more rainy days coming? That being said, the U.S. dollar, dropping. You have record low rates. What are some of your thoughts on yields and the dollar?
Okay, so we have yields setting up to touch record lows. If you take a look at the yield complex out to 10 years, what do you see? Well, last night, the 10-year touched 0.51, a record low. I sit here, I look at the 2-year at 0.12. You adjust that for inflation. We have negative rates out along the curve, right? So that's where we're at with the dollar. We're going to be spending a lot of money. We're going to be running very large deficits for a very long period of time. Now, I would make the case that if you can borrow out to 10 years, and because of negative real rates or inflation-adjusted rates, you can pay back less than what you borrowed, you're probably in a good space to run high deficits, especially targeting the development of a vaccine, the production and the distribution of it, followed by what I would call a once-in-a-lifetime infrastructure project to get this economy and get this country moving in. I think those are good things, but they will weigh heavy on the dollar going forward. I do not believe that it will cause the end of the dollar's reserve currency status, as some of the currency strategists at Goldman suggested this week, but we are going to have an extended period of what I would call a soft dollar.
So do you see anything better for jobs going forward in the next 6 to 12 months? I mean, it's been a little erratic. Continuing claims were looking better. Some of the furloughed workers were returning to work. But the last couple of weeks, we've seen those filing for unemployment on the rise, going in the wrong direction. And next week, Friday, we get our monthly jobs report. I'm really waiting for that. I'm not sure why, because I know that this whole time goes down as a scratch. But tell me.
Let's talk about some of the good things that have happened. There have been 7.5 million people recalled to work. That's a positive, right? These people are going back to work despite the fact that many of them could have stayed home and collected more money. That's a really good sign, and it tells you something about the resilience of the American workforce. However, once the economy started to go sideways in June and then started to really ease off over the last month, we expected to see an increase in first-time jobless claims and, of course, pandemic assistance unemployment. 1.4 million increase on Thursday. You add the PAU, it's 2.2 million. We're likely to see a very slow pace of worker recall in terms of the July unemployment report, and there's a risk we are going to see a negative print. During August, we'll see that the first week of September. I'm pretty sure we're going to have job losses that month based on the data that we're seeing. That is, we're using the Census Bureau's weekly survey and an array of alternative data to make these forecasts. Let me tell you, we live in a very different world when it comes to economic forecasting these days. I'm a proud member of the Wall Street Journal's forecasting community, and this is seriously the toughest time to be an economist during my entire career arc. Not complaining, it's just we're in a very different world these days.